Good evening, everyone. Today we're looking at financial reporting FR, and our topic for today will be IAS 16, property, plant, and equipment. Now, what is the scope of this standard? Let's look at the content of the standard. Now, this today's topic is a continuation of what we've done from our WhatsApp class. So I'm continuing from where we stopped in our WhatsApp class. So we will to cover the standard and move forward. So and for those that is not around or that is not added to the WhatsApp group, you can chat me or I'll send the material of our previous class and the solution and the question and solution to you via WhatsApp. Now, this standard we have the content of the standard. What we have to know as regard to IAS 16. Now, one we have to look at the scope of the standard, the recognition criteria, the initial measurements, subsequent costs, subsequent measurements, depreciation. Now, how will we account for depreciation? Then the recognition and disclosure. Now, let me let me try to explain our previous class to us. When we talk about the scope, I say what the scope. IAS 16 talks about tangible assets. So it covers all tangible assets. That is, it covers all tangible assets. So it does not cover any other standard that has been covered by other standard, or does not cover any other any other any other asset or any other illustration or any other question or any other treatment be covered by other standard. So the scope of this standard is that this standard does not cover inventory. So that one's by IAS too. So this standard does not cover any assets being held for third party. Any asset you are holding, maybe for construction on behalf of third party. So that is covered by our IAS 11 construction contract, but now it's no more in place. It's covered by the IFRS 15, which is also in our syllabus. So this asset does not cover impairment of an asset. So that is covered by IAS 36. So what is the recognition criteria? Now, how we recognize an asset? So an asset, the criteria for you to recognize an asset is that one, the asset cost must be measured reliably. Two, the revenue from the asset, it must flow to the what? To the entity. So as long as the asset, the revenue will flow, the future revenue will flow to the entity. We said that as that asset is your asset, that you can recognize it as an asset. So as long as that asset revenue will flow to you, so you can recognize it as your asset. That is the two recognition criteria. Now, initial measurement. Don't say initial measurement. Initial measurement is talking about how you measure an asset for the first time. Now, for initial measurement, you're talking about the initial cost of an asset. Now, the cost of an asset does not only consist of the purchase price. You talk about other directly attributable costs that you can that are attributable to that asset. For example, any other tax, non-refundable taxation on behalf that you paid to purchase the asset is a part of cost of that asset. Your carriage inward is part of the cost of the asset. If the asset, if the asset requires professional service for you to acquire that asset, so that professional cost of professional service is a part of that asset. So to save our time, you can look at our previous class, then understand that. Now, here we should start from subsequent course. But for subsequent course, there's other thing that is under subtopic of initial measurements that we can start from. Now, today we will be starting from exchange of assets. What is exchange of an asset? That means we're saying that you can purchase an asset even without paying money. That means you can exchange your own asset to acquire another entity asset. That means if a company has computer as an asset, and he wants to buy furniture from a particular company, and that company also need computer. So the company that has the computer can exchange his computer to collect furniture. So you are saying now the fair value of your computer will be the cost of that furniture. So let me read that from my notes. When an a- when an item of property, plant, and equipment is purchased for assets for cash, the cash paid is the cost of the asset. However, an item of property, plant, and equipment may be paid for using an asset other than cash. That means you can purchase an asset rather than paying what cash. Just like the way in football, what they do is that they can want to buy a player, they can exchange to another player. That is an exchange of assets. Or you can purchase an asset, bringing another asset and paying cash. Now, the cost of such items is measured at the fair value, unless that means if you are doing asset to asset exchange, the cost of the asset you are purchasing is the fair value of your assets you are giving up. So you must look for the fair value, or the fair value of that asset you are receiving will be the cost of that asset. I mean, fair value of that asset you are receiving will be the cost of your asset that you are purchasing. It won't be the book value of that asset you are purchasing. The cost of such items is measured at fair value unless the exchange transaction lack commercial substance. So the when it does not have when the asset does not have commercial substance, that's the only way you can use other measurement of valuation. The fair value of neither the asset received nor the asset given up is reliable. It's reliable. So that is only when you cannot use the fair value measurement. If the acquired item is not measured at fair value, it is measured at the kind amount of the asset given up. That means if I want to purchase furniture and I'm giving up a computer, then and there's no fair value that I cannot ascertain the fair value of my computer. Neither can I ascertain the fair value of the furniture. Then the cost of the furniture will be the kind amount of my computer. So let's look at fair value. What is fair value? So fair value of assets given up is used to measure the cost of the asset received unless the fair value of the assets received is more clearly evident. Fair value may be determinable with reference to comparable market transaction. Now, this fair value we're talking about um is a topic on its own, is a standard on its own, which is IFRS 13, fair value measurement. So let's read that standard very well. I believe I can might test that IFRS 13 in this July or March diet. If there are no comparable market transaction fair value is reliably measured. If the variability in the range of reliable fair value estimate is not significant for that asset, or the probabilities of the various estimates within the range can be reliably assessed and used in estimating fair value. Now let's talk about commercial substance. What do you mean by commercial substance? Commercial substance. We say And an exchange transactions as commercial substance if the configuration, risk, timing, and amount of the cash flow of the asset received differs from the configuration of the cash flows of the asset transferred, or the entity's specific value of the portion of the entity's operations affected by the transaction changes as a result of the exchange, and either of the above difference are significant relative to the fair value of the asset exchange. And we're saying that as long as we said an asset have a commercial substance, if that asset, if you can ascertain the cash flows from that asset, that the asset has risk, you can ascertain the timing of the cash flow asset. You see that asset has a commercial statement whereby you can use the cash flow to ascertain the fair value of that asset. Now, illustration 5 from also. We said Real Madrid buys B, BMW. The list price, which is the price is 92,000 naira. It pays cash of 80,000 naira and trades and trade in a VW. So that means Real Madrid buys BMW, he pay cash and also give VW that also give what VW in order to purchase that BMW. Now you are required show the journal entry for the above transaction. For the above transaction. So let's show the journal entry for the above transaction. So let's solve the question together. Now, for the journal entry of the above transaction, solution. No, that means for a journal we have the debit side and the credit side. So let's try, because who knows if I can we start their we will make ICANN exam suit online. So we should be able to use the computer. So yeah, this debit side and the credit side. So the debit side is what are they receiving? So they're purchasing BW. We'll put BMW. What is the value of BMW? You debit BMW with how much? We debit BMW with 92,000. They are giving out cash. They are giving out cash. They are giving out cash. So cash what you debit you credit your cash account. Cash account. You credit your cash account. You credit your cash account. So how much the cash account is 80,000. So they're also giving VW. So you credit the VW account. So VW is no more an asset of the company. because they are giving up VW in order to purchase BMW. So they are giving up cash and VW. So VW is no more an asset. That's why you are crediting VW. And the balance, which will be 10, the balance, which will be 12,000. So it's, you are not told. So the balance will be 12,000. So being what? So being the purchase, being the purchase, being the purchase of BMW, BMW with cash and VW. So that is the solution. Now let's look at subsequent costs. Subsequent costs. We'll talk about initial costs. Now, the subsequent cost of an asset. Now, subsequently, after you acquire the asset, you now make incur a particular cost on that asset. That cost might be divided into two. We said subsequent cost on non-current assets could either be capital expenditure, 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 that is that is capital expenditure or revenue expenditure. So when it's capital expenditure, that means the capital expenditure going to improve the quality of that asset. So you are going to capitalize that asset or capitalize that expenditure to the cost of the what, the kind amount of that asset. But if it's recurrent, maybe just like maintenance, so that one should be what, expense. That should be expense. Now here I explain the meaning of capital expenditure for us. I said capital expenditure. These are expenditure incurred on the improvement of a non-current asset during a particular period. They involve all repairs and maintenance on the non-current asset. So any repair and maintenance that you do on the non-current asset that improve the quality of that asset or increase the income capacity of that asset, you are saying is a capital expenditure. For example, you have a generator, or you have a car. You purchase a engine. You purchase engine. That means engine of a car. You cannot write it off as an expense. You have to capitalize it, but it will improve the car, the quality, the lifespan of that car. So, but if you just buys any other, for example, maybe you just bought a fuel, you bought fuel for that car. So that is an recurrent expenditure or revenue expenditure. Now, what is the features of capital expenditure? So if you are asking an exam, the feature of capital expenditure. So I gave out this is the feature of capital expenditure. So we have how many feature here? We have so we have 1, 2, 3, 4, 5, 6, 7. So we have 7 features of capital expenditure. We have it improved the quality of the non-current asset. It reduced the operational cost of non-current asset. So once anything you incur that reduce the cost of operating cost of that asset, let's say is capital expenditure. It significantly increased the useful life of the asset. So if it increases the useful life of the asset, we say it's a capital expenditure. It increased the quantity of output of the asset. So you purchase and it keeps going to you say it's a capital expenditure. It improved operational efficiency of that asset. It increased revenue capacity of that asset. So this is the future of capital expenditure. So what is the current revenue expenditure? We say revenue expenditure is expenditure that being incurred are incurred day to day on the non-current assets costs, such as servicing costs. So let's look at part replacement. Yes, the standard also talk about parts replacement. Why part replacement is a part of the standard? When you say for part replacement, for part replacement, for part for part replacement, that means you have a non-current asset. You now want to replace some parts. Then how will you account for such replacement? For example, ship, aeroplane, gas turbines. So when you replace some parts, such parts replacement, if it's of capital nature, you should what depreciate it. Some items are are a series of linked parts which require regular replacement at different interval and have dif- different useful lives. So such part replacement now, how we account for part replacement? The accounting treatment for part replacement. The entity should the entity should recognize the kind amount of the costs incurred on the parts replaced separately from the total carrying amount, the assets, and treat the depreciation differently. So when you have a part replacement, such a part replacement should be capitalized and treat it different from the other parts. That means, for example, you have an engine, you replace an engine of a car. That engine should be depreciated separately from the depreciation of the whole car. So that is the meaning of what part replacement. Now, what is major inspection? Major inspections. A company might only be allowed to operate some assets if those assets are subject a to regular major inspections for fault. Because now there's some assets that when you purchase them, it's compulsory that they make major inspection and overhaul on that asset. Without that, you cannot purchase that asset. So any asset that have a major inspection, the cost of such major inspection is recognized in a kind amount of the asset as a replacement if the recognition criteria are satisfied. Then we're saying if there is a major inspection on some particular asset, now the cost of that major inspection should be recognized separately from the cost of the whole asset. That means you have to capitalize the cost of the major inspection or overhaul and depreciate it separately from the other asset or for the whole asset. The amount capitalized will be depreciated over the period of the next major inspection. When the cost incurred at that point will be what capitalized. Now let's look at the illustration regarding to this major inspection. We said a shipping company is required to put its ships into a dry dock every 3 years. So every 3 years you put it in a dry dock for an overhaul at a cost of 3 million. So the major inspection is what is 3 million. The ships have a useful life of 20 years. The useful life of a ship is 20 years. A ship is purchased from a ship builder at a cost of 200 million. You are required show the accounting entry for the ship for the next 3 years. The accounting entry for the ship for the next 3 years. Now, for this major inspection now when you purchase the ship from the ship builder, The ship builder is the one that will make the major inspection on it. So he who construct the ship will knows what to do, will know how to maintain the ship. So, but at the point of purchase of the ship, the cost of major inspection is inside the cost of the ship. So you have to first separate it. So let's solve it together. Let's solve it together. So solution. Now, for the solution, for the solution, now the initial cost of the ship itself in the first year, that is year one. So you are saying year one, for year one, the initial cost, initial recognition for the ship will be the 200 million, 200 million minus the 3 million for the major inspection. So we are having 200 million minus 3 million. We have 987 million. So this is the initial cost of the ship. Why the the initial cost of the major inspection, which is the overhaul, is 3 million. Now, the annual depreciation, the calculation of annual depreciation for the 3 years. Now, calculation of annual depreciation for the 3 years. For the 3 years, we have annual depreciation. Which will be 197 million divided by 20 years. Divided by 20 years. So we have 9.85 million. 9.85 million. Why annual overall expenses? Annual overall expenses that will be charged to profit or loss every year. Every year. Every year. That will be 3 million divided by how many years? 3 years. So that means it costs them for 3 years. They will pay for 3 years. So they will be charging every year 1 million. 1 million per year. Now, let's construct the journal, accounting entry. Now, for the accounting entry for 3 years, for 3 years, accounting entry for what? For 3 years. We have the particular. We have the debit. Then we have the credit. So every year we'll be charging depreciation to our profit or loss. So annual depreciation. You debit your depreciation account, which is the profit or loss, with 9.85 million, and credit the ship to in the profit in your statement of financial position in order to know the kind amount of the assets every year. So the 197 million minus this depreciation will give us the carrying amount each year. So this one will be being annual depreciation of the ship charge to profit or loss account. So for the overall, we have same thing. We have debit and credit. Though you can also prepare. So this we have the annual overall expenses. Related to profit or loss, which is 1 million naira. Then the overall accounts, overall, overall, overall in your statement of financial position to arrive at the kind value of your overall. Being annual overall expenses charge to profit or loss account. So let's move on. Subsequent measurement. Subsequent measurement. IAS 16 allows a choice of accounting treatment after initial recognition. All items of property, plant, and equipment in a class can be accounted for using one of the two models. So IAS 16 said we can use cost model and what evaluation model for subsequently to measure and asset. So I use cost model. When you say cost model, you are saying the cost minus the depreciation. While the evaluation model, you are saying annually looking at the new fair value of that, or the the revalued amount of that asset. The difference between the valued amount and the previous carrying amount will give you also your evaluation surplus or your evaluation deficit. So evaluation of property, plant, and equipment. So let's look at property, plant, and equipment. Property, plant, and equipment is recognized at cost when it's first acquired. That means you cannot use the valued amount for an asset as the first time. That means the initial cost of an asset must be measured at cost. So subsequently, you can use cost model or evaluation model. Accounting for evaluation. Now, then how do you account for revaluation? This is an aspect you should understand very, very, very well. You should understand it very, very well. Because the more you understand it, the better for us. Because it will help it will also help you when you are doing your corporate reporting. Now, we are saying is either you measure an asset at cost or you measure an asset at revalued amount. Now, when an asset, the difference between the revalued amount of an asset and the kind amount, we said is either evaluation surplus or evaluation deficit. Now, let me explain. When an asset is downward revalued initially, the decrease is charged to profit or loss as expense. Now, I will explain this. When you when you revalued an asset, when you revalued an asset for the first time and it was revalued downward, maybe the cost previously is 20 naira. When you look at the new revalued amount, is now 18 naira. The difference is 2 naira. That 2 naira should be taken to your profit or loss as an expense. It's always called impairment. That means the first time that you revalue an asset, the first time and it's downward, it will be called impairment, and it will be taken to what? Your profit or loss. Now, if if the same asset is if the same asset is subsequently revalued upward, the increase in evaluation should be charged to profit or loss. Firstly, to offset the previous decrease, while the balance is to be charged to other comprehensive income. Now, that same asset was now revalued upward. Previously, it was 2,000 that was revalued downward. Now revalued upward up to the tune of 5 naira. 5 naira. Now, that 2 naira that was previously revalued downward will first of all go and debit your profit or loss as admin expenses to 2 naira to offset that previous 2 naira. Then the difference, which is the 10 naira, will be taken to other comprehensive income as your evaluation surplus. Will now take down to the evaluation surplus account. Now, let's look at another scenario. If the asset is initially revalued to be increased and after subsequently decreased, how we treat it? Now, if an asset was revalued initially, initially, if an asset was revalued initially, now it was increased. Now, that increase should be taken to what? Other comprehensive income, not other income, not profit or loss. It's other comprehensive income. Now, if that same asset is not revalued downward when it was really up before. Now you must first of all go and debit your other comprehensive income up to the tune of the previous increase. Then the difference will not debit your what? Your profit or loss. Now let's look at reviews of reviews of the remaining useful life and expected residual value. Now an asset might you might review the remaining useful life of an asset. That means you can say, okay, useful life of an asset is 10 years or 5 years. After some time, you naturally okay, based on the current trend or the legislation of the country, you review it to let me say 3 years or 2 years. And how will you account for such an asset? ICC requires useful lives and residual values to be reviewed at each year end. Any change in is a change in accounting estimate. The kind amount which is the cost minus accounting depreciation of the asset at the date of change is written off over the revised remaining useful life. So such review. Now when you review an asset, I will give us the formula. Now the subsequent depreciation will be your revalued amount or your kind amount over the revised useful life. So let's look at this illustration. This illustration. Manchester City Engineering owns a machine which originally cost 60,000 naira on 1st of January 2010. So the cost is 60,000 naira. The machine was being depreciated over its useful life of 10 years. That means the machine has a useful life of what? 10 years. On a straight line basis. On a what? Straight line basis. And has no residual value. So the asset doesn't have any residual value. On the 1st of December 2013, Manchester City Engineering, Manchester City Engineering, sorry, let's edit it, is Manchester City Engineering. So Manchester City Engineering revised the total useful life for the machine to 8 years. That means I say down from the previous 10 years. I say now okay, the total useful life of that asset instead of 10 years and they said from initially that revised is to be what? 8 years. Now you are required you are required calculate the depreciation charge for 2013 and the subsequent years. Now what is the depreciation charge for 2013 and the subsequent years? So solution to this question, solution. Now for instance, want to know the depreciation charge for the previous year. Of depreciation. Now the depreciation charge from 2000 the asset was purchased in January 2010. From 2010 to and the to 2012 to December 2012. It's how many years? So we have January, December 2010, December 2011 and December 2012, which is 3 years. 3 years. So depreciation charge from 2010 to 2012, which is what? 3 years. Which is 3 years. Which is 3 years. Which is 3 years. So it will be our annual depreciation. Our annual depreciation will be 60,000 divided by 10, because which is 10 years. Which is 10 years. To give us 6,000. 6,000 is the annual depreciation. Now our accum depreciation will be 6,000 times 3 years. We equals to 18,000. 18,000. So the remaining useful life now equals, they've changed it from 10 years to 8 years. The total is will be 8 years, and we've charged we've charged 3 years before, minus 3 years. So we're having 5 years now. We're having 5 years. Now the depreciation from 2013 upward, depreciation from December 2013 onward. 2013 onward. Now it will be depreciate. The formula will be depreciation equals the carrying amount. Because here we will look for the carrying amount. The carrying amount. If no carrying amount, you can say the revalued amount. You can say revalued amount. Revalue amount. Let me say, let me use or revalued amount over over the remaining or revised useful life. Revise or remaining useful life. If you don't change it, remaining useful life. So that is the formula. So under this question, let's increase the funds. So the depreciation. Sorry. Now the depreciation, the depreciation from December 2013 onward will be depreciation equals to carrying amounts or the valued amounts over revised useful life or the remaining useful life. Now the carrying amount is 60,000 minus 18,000 over 5,000. Then we have 42,000 over 5,000. Then give us the 8,400, which is the depreciation onward from 2013 onward. Now let's look at this illustration together. So when we look at this together, a machine purchase a machine was purchased in by Alaves PSC 3 years ago on 1st of January 2000 and year two. It cost it cost 150,000 naira, and its expected life was 10 years with an expected residual value of 30,000. Due to technological changes, the estimated life of the asset was reassessed during year 5. The total useful life of the asset is now expected to be 7 years, and the machine is now considered to have no residual value. The financial year of the entity ends on 31st of December. What is the depreciation charge for the year ending 31st of December? Year 5. Year 5. Year 5. So let's look at this solution together. Solution. Now, for the solution, for the solution, we are asked to calculate what is the depreciation from what is the depreciation for 31st December of year 5. So, but the asset was purchased. The asset was purchased in which year? Year 2. Now, we are asked to look for division in year 5. From year 2 to year 4, how many years have they charged? How many years have they charged? So it was 3 years ago. Year 2, year 3, and year 4. That is 3 years. They've charged 3 years. So we must look for the kind of amount for the what? 3 years. For the 3 years. So let's look at it together. Calculation. Calculation of carrying amount. Carrying amount as at year as at December. Let's put December. December year 4. So I want us to increase the font. So year 4. So let's look for the depreciation first. Depreciation, annual depreciation, annual depreciation. Annual depreciation. So minus the cost minus the residual value, which is 30,000, divided by 10 years. Divided by 10 years. Divided by 10 years. So the annual depreciation. So the annual depreciation. The annual depreciation will be equals to 12,000. Equals to 12,000. Now the accumulated depreciation, because we must look for the kind amount. The accumulated depreciation. The accumulated depreciation will be the 12,000 times the 3 years. Like the 3 years that they've charged. So we have 36,000. 36,000. Now the kind amount, the depreciation that will be charged, the depreciation charged, we don't charge for year 5. For year 5 will now be annual depreciation now. Annual depreciation now. Annual depreciation. Annual depreciation. Now equals the kind amount over the remaining useful life. So our kind amount will be one. Now remember that we are told that the residual value is no longer in place. That means we will add it back. So it will not be minus the accumulated depreciation, which is 36,000. 36,000. So we have this equals this equals 41,114,000. This equals 114,000 over the remaining useful life. We've charged 3 years before out of 7, so it remains 4 years. Over 4 years. So our annual depreciation will be 28,500. 28,500. Final answer 28,500. You can do illustration 3 everything as an assignment, and I will look at it. as an assignment. I will drop the solution to us via the WhatsApp. Now let's look at accumulated depreciation. So our next class before we proceed to our next standard, because our next standard will be IAS 36. So we will look at this then I will explain it, then we will solve the question before we now move to our next class.